We'll start with trust. What a trust really is, it's just simply a legal arrangement where a trustee holds and manages the property or assets for the benefit of others, known as beneficiaries. Now, there's a few key elements to trusts alone. So first things first, obviously, for a trust to be there, you actually need a trust asset. So what the asset is it's simply the subject of the trust agreement. Now, the appointor, and I'm telling you all of these things because I will get into more detail of different types of trust, and you need to understand what they each mean. So the appointor is the ultimate control of the trust. The settlor is the person who sets up the trust for you. So it's usually a legal representative in that case, or an accountant. The trustee itself is the party who holds the asset for the benefit of the beneficiary. The beneficiary is the party who receives the benefit of the trust. And the trust deed is the agreement which establishes the trust and how it is to be administered. These are the key elements of trust. Now, probably the most common trust is called a discretionary trust. So all this simply is where the trustee chooses which beneficiaries receive the trust property or the trust asset, should I say, and how much the trust of the property they get, or the asset, should I say. Now, the discretion of the trust, which is why it's called a discretionary trust, is the trustee has the option of splitting it up however they like. So that's a key thing about discretionary trust. That's the reason it's called a discretionary trust. Now, unit trusts are a little bit different. Another word for them is express trust. And the reason that it's called unit trust is because they allocate shares in the property or the asset for the beneficiaries in the trust agreement rather than by discretion of the trustee. So each beneficiary in this case is given an allocation of the trust of the property or the asset beforehand. So discretionary trust, it's to the discretion of the actual trustee. Unit trust, it goes by how many units or how much percentage or allocation each person gets. So that's basically the two main types of trust. Now, you will have hybrid trusts, which are basically a mixture of both. Now, a hybrid trust can go in a number of different forms. So, I mean, people do talk about all these different sorts of trusts, and a lot of them are hybrids. Some are discretionary. In a lot of circumstances, actual self-managed super fund will often be in a discretionary trust, but they can go in a number of different forms. So, I mean, each their own and that kind of thing. But best talk to your accountant about what suits you best if you are thinking about going down this sort of path. Next topic here I want to get into is companies. Now, there's two specific ones I want to get into because there is a bit of a distinction between the two. And the first one is a holding company. So a holding company is simply a company that is established to own shares and control over other companies called subsidiaries. These typically do not produce working assets or anything like that. So they don't produce goods or services, but they hold it on the operation of other companies. They hold it on behalf of something else. That's what they're pretty much there to do. Now, obviously, in that sense, their purpose is pretty much to control assets and provide strategic management over them and protect them against risk over subsidiaries. So it's all they're basically generally there to do is basically, I'd say, limit and diversify risk. That's generally I wouldn't say diversify, it's definitely limit and basically control, should I say, ownership sort of structures of different assets. That's generally what a holding company is there for. I'm probably a little bit more biased. I probably prefer a holding company over the next one, which is a trading company. So very simple, a trading company is a business or entity that specializes in selling products, actually trading to basically engage suppliers and consumers. And so they actually work. A trading company is something similar to, like, maybe you have a warehouse business, maybe you have a cafe, maybe you have something similar to that, something along the lines of that. Now, as I said, they typically specialize in purchasing, financing, and doing various other things to actually trade. So a trading company is simply a company that trades. A holding company is one that holds. There's two different things. The holding company holds the asset. Trading company simply trades whatever they do. Now, the key distinguishment between the both of them is the trading company will generally have a business within it that's actually trading it, whether it be products, services, or whatever it is. The holding company generally doesn't. It simply only has, but it's only set up to hold the asset. That's the key difference between both of them. So that's the key different structures of, I'd say, the main ones, should I say, of companies and trusts. Yes, there are different ones. There's hybrids of both of them. There's different structures, corporate trustees as well. I'm not going to get into that because it is quite complicated to explain, and it's also quite different to each scenario. It's also, it depends on who the corporate trustee is and what you kind of want to do. So all of that is very different things, but the fundamental main two are discretionary and unit trust, and the fundamentally two main companies is a holding company and a trading company, and that's the key differences between both of them. So obviously, talking about both of these, there's key advantages and disadvantages to both of them. So first things first, we probably want to get into trusts. And now this is going to vary slightly between the two of them. I'm not getting into massive detail because, again, this isn't financial advice, but if you talk to an accountant in your situation, they will, a good one especially, they will be able to give you the right advice. Now, I have numbers of them across the whole country who can give you the right advice via this. I've obviously got plenty who help me alone. So the first main advantage of trusts is asset protection. So in a lot of circumstances, you might be in a high risk job. If you're an anaesthetist, for example, right, and you're looking at an asset longer term, and you might have multiple, and someone could very much so come after you, and you don't, and let's say you don't have the right, maybe you do have the right insurance, but you still worry in that case. Trust can really protect that because the actual holder might not even be you, so they can't actually come after you for it. Tax efficiency is another thing. So, tax alone with trust does work differently to a normal, so should I say purchasing it in your normal name, should I say? It does work differently, and you can distribute it differently as well, so you can obviously limit taxation for those reasons. Again, talk to an accountant about that. Estate planning, passing the assets on to your next generation is really important as well. Quite easy to do with trust, especially if it's set up properly. Privacy and flexibility. So trusts do have privacy in the sense that people often will not actually know who the actual asset holder is. They won't even be able to find it out via any way means necessary unless they go do some very deep digging. And it's a lot of circumstances they still can't. I remember studying, and this is for anyone who studied law before, they'll know this, Carlisle and Carbolic. It's basically nearly everyone who studied law would know about Carlisle and Carbolic, the foundations of contract law and all that kind of thing. Not that it's trust, but you get into deeper legislation, learning about basically a family, and I can't remember the exact name, but there was a family basically in the UK. This is like 400 years ago, who had assets that, should I say, protected that even the state or the government at the time, so it would have been the empire at the time, couldn't find out who owned it, and they never got them for it. So, in those circumstances, trust can be very good, and flexibility as well. There are things you can do with trusts that are very good. And they're quite flexible around what you can do, granted it's set up correctly. So that's the reason you need to talk to the right accountant, because they will know this kind of thing very well. So that's a bit of the advantages of trusts. Complexity and cost is definitely the first disadvantage. Now, I'd actually argue, in my opinion, complexity isn't that much of an issue if you have a good accountant or good financial advisor or commercial lawyer who could set that up for you, for example. Simply because they can break it down in an everyday solution, but cost is definitely a thing. These costs thousands of dollars a year, and they're definitely not for the average person all the time. Losses can be trapped as well. Now, why I say that is because if you have losses in trust, it is actually a little bit more difficult to, should I say, transfer them, account for them, borrow against it to be able to get through it and that kind of thing. So you need to be really secure in what you're doing if you're buying in a trust. Borrowing limitations and limited control. Borrowing limitations is simply because if you're buying in a trust, not every lender will like it. Not all lenders actually even lend to trusts. A lot of them shave lending off trusts. There's all these various things that go on there. So that's something that is a thing. You'll notice that just by talking to a broker. Just ask them how many less lenders will borrow to a trust. He'll probably say most will do it, but he'll then ask you to define what trust you're doing, and that'll limit it further. And not only that too, it's not all. So it's going to, depending on how complex your structure is, will depend on who will do it. And generally the rates are also a little bit higher. Limited control. So the whole premise of setting up a trust is whoever is actually holding it on behalf of you better really trust them. That's the reason it's called a trust, and you better have it very well written out, because you don't have 100% control. You have a lot of control, but never entirely 100%. And you want it to be, Yeah, I mean, you want it to be a very good relationship, whoever has this. Finally, there is a shelf life to a lot of trusts. So, I mean, this will vary state to state. For example, I know South Australia has a longer shelf life than, for example, New South Wales. So that's something to consider as well. It's not, you could probably argue it's not necessarily a disadvantage, but some people would view it in this way. But anyway, companies, let's get into that. So the main advantage is there's very limited liability if it's set up correctly in a company. You can distribute it quite well across people or across different, should I say, entities or assets as well. And it's limited to what you have. Access to capital is actually a very good advantage to it. So I mean, you can do this with trust as well, granted it's set up in the right way, but you can effectively limit, not have unlimited, but almost have unlimited borrowing power if it's done the right way and you buy the right assets, because an entity, a company or trust can take care of its own debt obligations. So you have the right, entity structure, you might be able to actually get that sorted very well. Now, in saying that, it's not completely unlimited. It has to be done the right way, and this can change very quickly. So again, talk to an accountant about this. Continuity. So again, passing it on, you could probably put that / estate planning down. Passing it on to the next generation, quite easy to do with companies as well, especially if it's set up in the right way. Flexibility and ownership structure. You can hold different, holding companies is a good example, different amounts of percentages of companies. You can be the sole shareholder and actual director of companies. You have definitely flexibility in this. So all of those are good things as well. Clear disadvantages, cost and complexity. Again, it is more costly and complex to do. I'd say complex wise, again, like trust, it's probably not that complex if you have someone who knows what they're talking about, can explain it very easily to you. So, but cost is definitely a thing, no doubt. To add to that, compliance and reporting, companies do have more reporting they need to do. So keep that in mind. Double taxation, you don't get in companies the 50% capital gains discount in companies. It does not exist. You don't get negative gearing in companies either. So just keep that in mind. That does not exist. Again, talk to an accountant about this. More formalities. So you might even have a company constitution or a draft document, something similar that you kind of have. So, that's a really important thing as well, just to keep in mind. You want it to be really down packed, and if you're doing it with someone else, you want it to be absolutely down packed. You probably want it even to be reviewed by a lawyer. So if anything were to go wrong, they at least have legal oversight of it to give you an idea. Finally, there's still some risk exposure. So people can come after you in different ways in companies to give you an idea. So, there is still risk exposure. Each of these are going to suit different people a different way. So some people a trust might suit them better, some a company might suit better, but each their own. Again, I haven't done advantages and disadvantages for the difference of a, should I say, discretionary trust, unit trust, or hybrid trust. This is as general and it's the same as a holding company and a, should I say, trading company. They're different as well, but generally these are your advantages and disadvantages for both of them.